Aloha and welcome to SC Finance Strategies and Insurance Consultants YouTube channel. This video today, I'm gonna lay out for you what I call the tax-free cash growth warehouse medium funded business suite. This is one of the most advantageous, one of the most powerful ways to use the tax-free cash growth warehouse strategy. If you're a business owner and you're not doing this, you're losing a lot of free money. And I'm going to explain all that to you as we go through this. This application, this example is straight out of my book, Tax-Free Cash Growth Warehouse Nuts and Bolts. And it is chapter 3 of the book. Every chapter in the book is a specific example, and it's fully laid out just as you will experience here in just a couple minutes. So, and if you find this to be useful, if you like it, I hope that you will please subscribe to the channel and also like the videos here. And I guess click on that little bell and underneath the video here, and that'll notify you whenever a new video is posted. Okay, so here we go. This is the tax-free cash growth warehouse medium funded business suite directly from chapter 3 of the book, Tax-Free Cash Growth Warehouse, Nuts and Bolts. I love this strategy. We certainly use it ourselves, my wife and I, as we're self-employed and business owners, and so we definitely use this. But let me explain it to you how it works. And obviously, the greater the funding of a policy, the more you can do with it and the more it gains for you. And remember, the gains are tax-free. So this particular example is using a service type business with a known regular monthly cost of expenses. However, the strategy works just as well for any business that sells products, or services. The sweep account idea would be used in the exact same way. The expenses in the case of a product-based business would include the cost of the products to be sold. The example we're using for this particular example is a client who has a business and owns a few service facilities. He's had them for long enough to know what the monthly expenses are, and they don't vary very much at all. He knows what the gross annual receipts are and what his gross annual profits are. He learned about the tax-free cash growth warehouse strategy and wanted to incorporate it into his business. Each of his facilities has a monthly expenses of right at around $11,000. And here's how we set up his account and how it is being used. In order to prevent the account from becoming a modified endowment contract, or MEC, which would then lose the tax-free growth benefit, and with the amount of money that he wanted to put into it, we designed a $2 million whole life participating policy with a base whole life of approximately $600,000 and a term supplement rider of about $1.5 million. We added a scheduled paid up additions rider so he could infuse an additional $5,000 into the account every quarter, $20,000 per year. And we included an unscheduled paid up additions dump in to start the account in the amount of $100,000. By putting the $100,000 in at the start, he was able to take a policy loan immediately in the amount of $35,000. Which is enough to cover the first quarter's expenses. The design of his policy actually had the full $100,000 going into the cash value right away of his account, so he could take policy loans of considerably more than the $35,000 if he wanted to. Now, he takes the policy leverage loan of $35,000, puts the money into his business checking account, and then he writes checks, as usual, to pay the expenses as they occur. Then at the end of the quarter, he pays the entire policy loan off and puts in the additional $5,000 by way of the paid up additions right. Immediately after he pays off the previous loan, he takes another loan for $35,000 to cover the next quarter's expenses, puts it in his business checking account and so forth. In this case, as he is using this for business, the small 5% simple policy loan interest is a business expense, and as such is tax deductible. In this scenario, the cash value of the policy is growing at 6.4% annual compounding dividend interest. And the 5% interest on the policy loans he deducts from his income tax as a business expense. So how does all this work out for the advantage of the tax-free cash growth warehouse strategy user? To start, he's growing his cash inventory at the rate of 6.4%, which was the dividend interest rate at the time that I published this book. And that's with zero risk of loss, absolutely zero risk of loss. He's using the cash value to operate his service facilities without interfering with that cash value growth. And the small amount of interest he pays on the policy leverage loans, he deducts from his income tax as a business expense. I'm going to graph this out for you in a minute. Using only the funds that are being used with the tax-free cash growth warehouse strategy, that is the leverage loans, that's $35,000 per quarter, and never mind all the additional cash that is growing in the account, here's how well that works out. Okay, I'm going to share my screen here, so hold on. Now, the $35,000 that the business is consuming each quarter is growing by $560 per quarter tax-free. The current dividend interest as of the writing of this book with the provider that we used for this client is 6.4%, or was 6.4%, or $2,240 per year. The $437.50 at 5% of interest that he pays per quarter is dedicated or is deducted from his income tax, and that amounts to $1,750 per year. So he also saves the $2,230 in opportunity cost that he would otherwise give up by paying for the business expenses out of the gross income from the business. Essentially, he's gaining $4,460 per year in dividend interest just on the $35,000 leverage loans, quarterly leverage loans, and saved opportunity cost, while also saving $1,750 in taxes that he would otherwise have to pay. With the tax-free cash growth warehouse strategy, he's coming out ahead some $6,210 a year versus paying cash for expenses out of the business's income. That equates to a 17.74% gain on the quarterly repeating expenses of $35,000, and no taxes are being paid on this. So with the $100,000 upfront infusion into the policy, the owner could easily borrow enough to take care of the quarterly expenses for all three of his service facilities. However, in order to keep all of his businesses distinct and their operating costs and revenues separate, he decided to open a separate TFCGW policy for each of them. If it so happens that the client in this scenario also has 4 children and a wife. So, and this is an important point. A person may own an account that insures someone other than themselves as long as there is an insurable interest between the owner of the account and the insured party. So what constitutes an insurable interest? Any living relative, a business partner, or key employee all constitute an insurable interest. As the owner of the account, One also has control of the cash value and determines who the beneficiaries are. So even if a person can't qualify for a policy insuring themselves due to age or health considerations, they may still own a policy that insures someone else and thereby may still utilize the tax-free cash growth warehouse strategy. A person may also own multiple policies insuring themselves. That is, as long as they qualify. Most insurance companies will limit the total amount of insurance that they will allow on a person based on their total net worth and or a multiple of their annual income. So for this particular design, which is a $2 million participating whole life tax-free cash growth warehouse designed policy with a front load of $100,000 and a quarterly paid up additions rider of $5,000, the premium for a 35-year-old non-tobacco user with a standard rating would be $32,940 per year. For a 35-year-old female, it would be $30,518. For a 45-year-old male, $42,537. 45-year-old female, $38,132. 55-year-old male, same policy, $59,033 would be the annual premium. That's all including the $20,000 annual paid up additions, right? For a 55-year-old female, it's just $51,486 per year. For a 65-year-old male, annual premium would be $85,519. For a 65-year-old female, $74,240, and so on. So according to the actuarial data, females live long. Therefore, the risk in insuring females is lower. Hence, the premium cost for females is lower for life insurance than it is for males. And now I know that this is of great interest to you, so following will be a partial illustration of the cash value growth for this particular policy in this example. Now, this table shows the cash value in the left column and the face value or death benefit in the column on the right. These values are for years 6 through 16 of this particular policy. This is including the $100,000 that was front-loaded into the cash value at the start of the policy, and with the quarterly premium of $59,033, which includes the $5,000 scheduled paid up additions every quarter, $20,000 annually. So you can see that over the 10-year period illustrated here, the cash value grows by $67,606 between year 6 right here and year 7. The difference between the cash value there is $67,606, and the amount of premium paid in was just $59,033. And look down here in year 10. Let's see. Year 10, the illustrated values here, total of 590,000. I'm sorry, let me back up. The cash value grows by $88,863 in year 10, 6, 7, 8, 9, 10. Between 10 and 11. And again, only $59,033 is being paid in premium. That's a 66.43% gain in year 10 over what is being paid in. And all that growth is tax-free. So while over the 10 years illustrated there here in the previous screen, there was a total of $590,330 paid in premium. The cash value has grown by $782,499. That's a 32% 32.5% total tax-free gain over the 10 years. Add to that all the opportunity cost that was saved and the taxes that don't have to be paid. Well, I think you can see what a huge advantage that this strategy really presents. Remember, we're only considering the $35,000 leverage loans every quarter for the cash value growth and savings of opportunity costs, etc. But the compounding effect of the gains in reality are much greater because the starting cash value is $100,000. And this client is infusing an additional $20,000 every year. So the dividend interest is being paid on the whole amount of cash value, not just the $35,000 leverage loans every quarter. I'm going to go back to the previous slide here for a second. And now check this out. So notice, by the way, the death benefit, okay, over here, starting in the year 6, it was 2.5 million. In year 16, which is a 10-year period of growth, 2.979 million. Might as well say 2.8, $2,979,956,000. So it's grown by very nearly $1 million in that 10-year period. And the premium has not changed a penny. Again, this example is taken from my book, Tax-Free Cash Growth Warehouse, Nuts and Bolts, and is fully laid out as chapter 3. Both books, Tax-Free Cash Growth Warehouse, the 178-year-old secret, and Nuts and Bolts are available on Amazon.com. It is important that you understand that it is critical that the account be designed correctly in order to utilize the infinite banking tax-free cash growth warehouse strategy. And that most insurance agents have no idea how to properly design an account to facilitate this strategy. So while you may have a good grasp on the strategy itself, you must work with an agent who knows how and is experienced in designing accounts for the strategy. Otherwise, you will get stuck waiting for years to accumulate sufficient cash value to put it into use. Now, I'm not licensed in all states, but if I can't help you, I can refer you to someone who is qualified and can help you. Meanwhile, please subscribe to this channel and click the like button for the videos. Also, please post your comments and questions here. And feel free to email me or schedule a phone call with me on my Calendly page. The links and all the info for that is below in the description box. We're here to help. We want to help you. Aloha and mahalo for watching.